Inflation seems to be the big data point that investors will be focused on this week. And we saw that massive move in the month of April. And every economist, really, from JP Morgan to BTIG, Goldman Sachs over the weekend, saying that this is the #1 data point to watch. What are you expecting, and how do you think investors will respond?
Yeah, I mean, it's a great question, and it is top of mind. Inflation is definitely out there, right? I think that some is transitory, meaning in the commodity sector, I think you have seen a pullback, which is very healthy, and I do think that is transitory. But I think on the wage side, that's certainly something that I have been focused on for a while. If you look at unit labor costs at 1.7%, you look at the ISM prices paid index, that's the second highest on record. Then we had the non-farm payroll numbers last week, and the last 2 months we've seen a definite rise, 0.7% in April, 0.5% last month. And just listen to what companies are saying. They can't find people, and when they do find people, they have to pay up for these people. So I think this is certainly something that is top of mind. I do not think this part of the inflation is transitory. So it is certainly something that the Fed is watching. And there's no question they're going to taper. It's just a matter of timing. They probably should at this point.
Yeah, and speaking of labor, 1/3 of industrial companies, many of which I know you've invested in, actually cited the labor shortage issue during this earnings season, something that Bank of America analyst Andrew Lobin has been pointing out. But 2 jobs, I mean, it looks like the market interpretation of that May jobs report was that it was weak enough to push back those taper talks from the Fed. Was that your interpretation as well?
I mean, it was a solid number, right? It was really a great number. And I think what was very encouraging and what I think is the new theme here in the marketplace is we've seen the renaissance in manufacturing. You know that, I know that. We've seen the PMIs, the ISMs, durable goods. We've seen even a CapEx spending starting to improve. Last week we got on the manufacturing side record ISM manufacturing. But I think what we're on the cusp of right now, Seema, is really the shift into services. I think that's really going to take off. And I don't think the earnings have inflected positively yet as a result. We've seen the reopenings, we've seen the recovery stocks do well, but I think earnings are really poised to move much higher. And the reason it's encouraging, services is a lot bigger piece of the economy versus manufacturing. So we're rooting for services to do well. But we've got a lot of data. ISM services hit a record. IHS, the market services PMI hit a high last week. The ADP number had services driven in terms of jobs. And then again, to your point on non-farm payrolls, it was a solid report. And it was led by services. 292,000 jobs were created in services alone. And so I think the report was strong enough. I do still think, though, that the #1 item for the Fed is really going to be inflation and watching what's happening on the wage front.
Yeah, and then we have retail sales on Friday as well. If you look at year to date, the sectors that are just the biggest standout, energy, right? And there was such a head fake over the last couple of years, investors really losing confidence in that energy trade, saying oil prices at peak. There's no way they'll get back to $80. But here we are with Brent crude back above $71. And I'm wondering whether you think this trade has run out of steam. Is it too late to buy some of the big oil giants that can obviously really capitalize on the higher oil prices we've seen in recent months? Your thoughts there?
Yeah, I mean, I think the cyclicals and the economically sensitive sectors, which energy is included in that, they remain very attractive because I do think that the operating leverage is very substantial. And I think you're right. People did get burned in energy, myself included, by the way. But I am now overweight in energy. I'm kind of taking a barbell approach. I own Chevron because I like the dividend. I love the management and I like their assets. And I also like their M&A strategy. And I have Schlumberger as well. I think it's a hidden gem in technology, right? It's only 13% of total revenue headed up to 25% in the future. So I think you can pick your spots within energy, but I also like financials. I like industrials. I do like the discretionary names, and I'm not abandoning secular growth. I'm just more particular because they're not exactly cheap.
What do rising oil prices mean for a company like GE, which has seen its stock double in recent months, but is also diversifying its portfolio and really leaning into renewable energy?
I mean, I think that Larry Culp is doing a great job in transforming that company. He's shrinking the company to grow, really. And he's focused on healthcare and aviation. And they do have exposure, obviously, on the energy side, too. But I like the fact that he's focusing on where we're going to see growth going forward. And I think he's done a very good job. And slowly but surely, he's making small acquisitions to beef up those 2 areas. And of course, we had the Airbus news last week, right, about increasing production, increasing demand. That's very positive for GE. They're one of 2 engine suppliers to Airbus. So there's a lot of good things happening at GE. I own it, so in full disclosure, but I do think that the restructuring is definitely taking hold, and I think there's a lot more that they can do.
Shepard Smith here. Thanks for watching CNBC on YouTube.